So for a merger arbitrage strategy, I think there are three outcomes, right? So historically, folks have viewed mergers as binary success or termination. The third outcome is
So you spoke a little bit about the merger arbitrage strategies you guys run at Verser and the fact that you frame the outcome into three different categories. I guess just for myself and for our listeners, what three categories are those? Like, how do you bucket the predict? What are you trying to predict when you're going through for an event-driven trading strategy like that?
yeah. So for a merger arbitrage strategy, I think there are three outcomes, right? So historically, folks have viewed mergers as binary success or termination. The third outcome, so we believe there is success, there's termination, but within success, there's two different pathways. There's a pathway where the deal completes at the agreed upon terms, in which case all is fine, and you collect that whatever the spread was between the offer price and the stock price. But the third outcome is there is an upward amendment of price or competing bid. That is to say that there's another financial market participant that comes in and offers a higher price, or the management team negotiates a higher price for their company. When you look at the data, just statistically across all merger deals over the last few decades, 8% of deals fail. Right, uh, double that amount actually has an upward amendment or price or competing bid. To the extent you're able to accurately predict those deals that are susceptible to an upward amendment or price or competing bid, we think that's an interesting advantage. And when framing our problem and the problem we're seeking to solve, we think it's very important to pay attention to that 60% of deals that likely have an upward amendment or price or competing bid that potentially can give you an edge in terms of return outcomes.
Fascinating. I've never heard the problem framed that way. And when I was reading one of the articles that Yash sent me, another partner at Verser, before this podcast, I found it fascinating that your model predicted a 40% likelihood of a competing bid for, one merger arbitrage deal. And that ended up happening, and it turned out to be a really profitable trade. DeWayne, can you walk me through that case study for our listeners? What was that? How did that go? And what was the process in building out that thesis?
Yeah. So that was a deal, without trying to get into the wonky aspects of the transaction itself, but it was a UK-based industrial technology company that was seeking to be acquired by one of his peers, competitors in the space. Ultimately, what happened was a financial sponsor, a large private equity firm, offered a higher price. And that deal closed at substantially higher price than the market was initially predicting. How do we go about analyzing deals like that? The first step is framing the problem. So the problem I just articulated was we're trying to solve for the probability of upper amendment price or competing bid. But there's several other problems that we're trying to solve for in any given merger transaction. Another problem we try to solve for is the probability of deal failure. In a transaction like that, when we ran it through our models and conducted our analysis, that particular transaction had a really low likelihood of deal failure. That's really interesting aspect. The probability of competing bid, as you articulated, and we've published about this, was quite high, of 40% probability. There are lots of features that we look at, without getting into the gritty details, that help us assess that. But one of the things that one might evaluate, with it's somewhat intuitive, is looking at deal spreads. A negative deal spread at announcement is an indication that the market thinks that there's likely to be an upward amendment or a competing bid. What's interesting aspect about deal spreads is that negative deal spreads actually have a very high cancellation rate for a number of different features. The third thing that we try to solve for is that we're not likely to get it right all the time. Right, we work very hard. Occasionally, there's something will go wrong in the case of owning a portfolio of merger arbitrage deals. What we try to forecast there is, except we get it wrong, what's the downside? How much will we lose? An interesting thing to think about is, let's say a large pharmaceutical company is buying a biotech IPO, a recent biotech startup that has one or two technologies or a drug or so, it's very likely, to the extent that deal fails, it's not going back to where the stock prices was trading ahead of announcement. It's probably going to something close to zero. That's something that's a very important feature, that one that needs to care about. The third thing we predict, another aspect that we predict, is how long a deal takes to close. Um, we'll come out with an estimate of how long the duration of a deal. To the extent it takes longer than that, that introduces another risk. The idea is, if two folks are taking longer to get married than they anticipated, perhaps they won't get married at all. And then we incorporated that with a forecast of volatility, right? So we want to get a sense for what's the path to closing. Um, most deals close. Not all deals close with the same glide path. We want to make sure that we measure that glide path. What's the volatility? What's the market risk associated deal, in order to size deals appropriately? So all those things that I mentioned, and I mentioned quite a few, and there are a few other things that I haven't mentioned, we come up with an expected rate of return and a risk level associated with expected rate of return. You could think of this as a Sharpe ratio a Sharpe ratio, so to speak, with each deal. And then we want to go about optimizing our returns. So we increase exposure, have highest level exposure deals that are particularly attractive, particularly attractive risk return profile. Exclude deals in a number of cases that don't have particularly attractive risk return profiles, and underweight deals and overweight deals based on kind of any variation of those things I mentioned.
Do you have a max size for any particular merger arb trade? Would love to hear it.
The way that we go about sizing transactions is a number of different features involved in that. So one is kind of the risk return profile of any given deal. The second is the general merger environment. How particularly risky the overall environment is. One of the things that we look at is deal spreads, so the mark-to-market risks of overall mergers. To the extent deal spreads are particularly volatile, there's higher amount of volatility associated. Deal spreads will take lower exposures. To the extent they risk true, will take higher. And then we look at the number of deals available to us in environments where there are lots of deals. That allows us to put a lot more bets across several different transactions. All feature into kind of how we think about sizing positions in terms of specific max positions. That varies over time based on the environments that I described. But there are rules in place that we do employ.